Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 25th of March 2025. So as usual, let's have a quick look at the disclaimer first before we jump into the gist of today's Daily Dose. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of key economic data release events and as well as their respective impact on the broad-based cross-asset classes. So let us start with the relevant events first and news flow. So what you could see over here is that yesterday at the start of early US session, Trump actually made another round of rather, I would say, positive remark, stating that the upcoming 2nd of April reciprocal tariffs against US major trading partners, especially those that has a significant trade surplus with the US, he may exempt some nation, all right, from reciprocal tariff. And he also did mention that several other goods related products like lumber and pharmaceutical could come after the 2nd of April. So that actually implies that Trump is ready to actually open the door for further trade negotiation with the targeted countries. That's his usual style of giving this kind of uncertainty and erratic way of or what I call it, implementing his trade tariffs policy. And we know that there's a couple of 1 more week to go before 2nd of April comes in. Things could actually still change. But however, from a very short-term perspective over here is that the US market continues to rally. So that actually also came in within our expectation. So those who followed my daily dose of market insight yesterday we do flip to a bullish bias on the Nasdaq 100 for this residual corrective rebound to play up. So the Nasdaq 100 hit our first resistance zone that we expected at the 20,150, 20,200 mark. So if you look at the performance of all the major US stock indices, all of them close in the green. So S&P is up by 1.76%, the Nasdaq is up by 2.16%, the Dow Jones Industrial Average is up by 1.42%, and the Russell 2000 is up by 2.55%. But however, whatever rally that we see so far since late last week is more likely to be a counter trend rally, or I would say that it's a counter trend corrective mean reversion rebound rally within a medium term downtrend that is still intact since the start of this year for the major US stock indices. And why do I say that? Because from a fundamental perspective, liquidity is expected to tighten in the US. So yesterday we do have one Federal Reserve official speaking, Fed Bostic. So Fed Bostic sees only just one rate cut this year due to the inflationary impact from tariffs. So that actually also fundamentally speaking, the Fed will not be so generous in cutting interest rates, or even their hands are pretty much tied if US economic growth is expected to slow as expected by OECD latest global economic report that was released last week, right? Last week, where they downgraded global growth and downgraded US economic growth for 2025. So despite if the US economic growth slow down, the Fed hands are pretty much tied. That means, i.e., they may not be able to use that traditional interest rate cut tool to jumpstart the economy because of that stagflation risk at play. All right, and this stagflation risk at play also starts to play out in the forward-looking 5-year break-even rates. All right, so this 5-year break-even rates, the one that is in darker green, and a 10-year break-even rate more longer term in lighter blue, darker blue and lighter blue. Darker blue is the 5-year break-even, and the lighter blue is a 10-year break-even. So those who followed my intermarket analysis or intermarket highlights a couple of weeks back, so I tend to use this 5-year break-even and 10-year break-even as market gauge of what inflation expected to be 5 years from now and 10 years from now. So basically, this is being derived by market transacted TIPS, is the Treasury Inflation Protection Securities or Treasury Inflation Protection Bonds. So based on these protection bonds, the forward-looking inflationary gauge is continues to tick upwards. So the 5-year break-even rate is now trading at 2.54% as of yesterday US session close, and the 10-year break-even is trading at 2.36% as of yesterday close. So what I could see over here is that the major uptrend continues to remains intact for these two break-even rates since September last year. All right, so that implies that market is actually expecting inflation trend in the US to creep higher going forward rather than creeping downwards. All right, so that also explained to us why several Federal Reserve officials, especially Fed Bostic yesterday, he is rather hesitant to actually see more interest rate cut this year, despite the fact that there is a risk that the US economy may slow down due to Trump's erratic and aggressive trade tariffs approach in the way he wants to implement them. So that absence of liquidity injection in the US economy, if the US were to slow down, that could actually cramp down earnings growth, and that could also suck out the bullish optimism in the US stock market as well. All right, so this is something to bear in mind. And because of the uptick in this forward-looking 5-year break-even inflation rates over here that I share with you, and also as well as Fed Bostic rather less dovish expectation going forward, that causes the US dollar to continues to rise, all right, across the board. So what I could see over here is that the dollar continues to actually outperform against the Kiwi, the Aussie, and now as well as the Euro. So late last week, we flipped to a bullish stance on the Euro dollar. That means, i.e., we're expecting we flipped to a bullish stance on the dollar. That means we're expecting the Euro dollar to slide, the sterling dollar to slide, the Aussie dollar to float up. Okay, so the Aussie, okay, pardon me, I repeat again. We are expecting the Euro dollar to slide, the sterling dollar to slide, and the Aussie dollar to slide, which indeed it takes shape in the last 3 sessions. And we turn neutral on the dollar yen because of that potential squeeze up that has taken shape. So the dollar yen yesterday broke above the 150 level, 150.50 level, and now floated back up to a medium term pivotal resistance zone, which I'm going to highlight to you all later. So in fact, if you look at the dollar yen right now in today's Asia session, after hitting close to that medium term pivotal zone at around the 150.90 level mark, it starts to actually trade inch down lower in today's Asia session right now. All right, so it's now not so strong as versus against the dollar euro, the dollar Aussie, and the dollar Kiwi. So later I'll touch on the short-term intraday technical outlook on this major dollar pairs for you guys to have a clearer view on today's intraday trend as well. And what's interesting over here is that yesterday we flipped to a bearish stance on the 3 months high flying Hong Kong stock indices. So that is taking into account of the broad-based rally or the return of positive optimism on China big tech stocks. So the Hang Seng indices continue to decline over here. So what I could see over here is that it's more related to a technical play where the Hang Seng indices has reached a kind of a overstretched rally, which I highlighted to you guys 2 days ago. And the Hang Seng index continues to slide down below our short-term pivotal resistance, which I highlighted yesterday. All right, and also with the strength of the dollar coming back as well, the gold price also continues to actually remain sluggish. So if you look at gold price over here, it continues to trade below the 3038 level. So that's our short-term pivotal resistance that we highlighted. Retested 3000 yesterday for XAU/USD before trading sideways. All right, as we are speaking. So if you look at gold price right now, it's trading around 3011. So later I'll highlight what are the key levels to watch on gold. And what's interesting over here is that West Texas crude oil continues to break out above the 68 level. The reason why West Texas crude oil actually has a sharp jump yesterday was due to the fact of Trump's planned tariff on countries that buy Venezuela oil. So what Trump's actually mentioned yesterday, that irregardless of whether you are a traditional alliance with the US, as long as you buy Venezuela oil and gas, there will be a sanction placed on you of 25 tariffs, okay, 25 tariffs on countries that buy oil and gas from Venezuela. So that actually causes the oil price to actually spike up 1% yesterday. But nevertheless, do not forget over here is that oil price is going to be traded in a big choppy sideways range. So on the top side, there will be a potential ceiling coming into play because OPEC Plus is likely to proceed with the planned May output hike. More or less or so, and also there's this ongoing potential US-Russia ceasefire talk that is more pertaining to this ongoing conflict on Ukraine and Russia that may see some form of light at the end of the tunnel. All right, so that could actually potential cap further bullish pressure on oil. All right, so net overall, for those who actually look at my technical outlook on oil, my expectation is more related to a mean reversion rebound in oil rather than the start of a bottoming major bullish formation in oil, because i.e. perhaps around the $70 per barrel, we may see some kind of downside pressure coming in again, $75 per barrel. So later I'll touch more about the West Texas crude oil short-term intraday levels and outlook to watch out for today. All right, so that sum up the first session, the first segment of today's Daily Dose of Market Insights. So let me expand my screen to jump into the second segment, which is the intraday technical outlook. All right, so let me start with the FX market first, which is the euro dollar. So the euro dollar came down, inch down lower as expected over here, clear below the first support level at 1.0805. You could see over here 1.0805. And right now it's attempting to retest this level over here by trading a few hour session of sideways below at the 1.0805. So with that, we have a slightly adjusted, we call it short-term pivotal resistance for today, taking into account of yesterday's European session high that got rejected by this hourly bearish shooting star formation or shooting star candle that ended at the 4 p.m. mark in Singapore time, the hourly candle. So using 1.0860 short-term pivotal resistance on the euro dollar, maintaining the intraday bearish bias. First near-term support level to watch will be 1.0765. A breakdown below it exposes 1.0730, which confluence with the 20-day and the 200-day moving average at these two resistance level. Only hourly close and a push up above 1.0860 will invalidate today's intraday bearish bias to see a squeeze up to retest 1.0910, and above it may see the medium-term pivotal resistance zone coming in again at 1.0940/1.0970. So in a nutshell, still maintaining that intraday bearish bias on the euro dollar using a slightly adjusted downward pivotal resistance for today at 1.0860. Onward next will be the sterling dollar. So the sterling dollar continues to shape that bearish reaction exactly at our short-term pivotal resistance that we highlighted yesterday at 1.2980 by printing this bearish small doji spinning top light pattern at the 6 p.m. mark, hourly mark at Singapore time yesterday. All right, so still no change for sure. The 1.2980 is indeed a short-term pivotal resistance level to watch to maintain today's intraday bearish bias on the sterling dollar. First support level to watch will be at 1.2865, which corresponds to the 20-day moving average. A breakdown below it may see a further dip down towards 1.2810, which corresponds to the 200-day moving average. Okay, so these two levels, graphical levels, are pretty significant. Support level 1.2865 followed by 1.2810 because they confluence with mathematical indicators, which is the 20-day moving average and the 200-day moving average of the sterling dollar. However, only a squeeze up and the hourly close above 1.2980 short-term pivotal resistance level will invalidate today's intraday bearish bias on the sterling dollar to see a squeeze up to revisit 1.3025/13040. Above 13040 may see the psychological level of 131 figure coming in, which is also correspond to the minor swing high area of 8th of October and 16th of October last year. So i.e. in a nutshell, still using 1.2980 short-term pivotal resistance on the sterling dollar to maintain its bearish bias for today. Next up will be the Aussie dollar. So the Aussie dollar continues to trade sideways, but below the 50-day moving average and the 20-day moving average, which was also our short-term pivotal resistance that we have for yesterday at 63.05. Still no change. As long as 63.05 holds, still maintain that bearish bias on Aussie dollar. First support level to watch out for will be 62.60. Only a breakdown below 62.60 may expose 62.40 next. And in order to see a deeper slide, 62.40 got to be taken out to revisit 61.90, which is the minor swing low area of 28th of February and 4th of March. However, a squeeze up and an hourly close above 63.05 will negate today's bearish bias to see a kind of a choppy upward drift to revisit 63.25, followed by 63.45, which is also the close 63.45 and 63.60 over here. So this is the 63.60 is the minor swing high of 20th of March that induced the last leg of minor weakness, the recent leg of minor weakness on the Aussie dollar, and as well as the pullback resistance of the former minor ascending trend line support that I drew from the low of 4th of March. All right, so i.e. in the nutshell, still using 63.05 as my short-term pivotal resistance to maintain that intraday bearish bias on the Aussie dollar. Okay, last up will be the dollar yen. So dollar yen, yesterday we were neutral between the 150 level and 150.50 is squeeze up, all right, and come very close to the medium term pivotal resistance level of 15130/80, which correspond also to the 50-day moving average and the 200-day moving average, I think as a similar resistance zone on this 15130/15180. And what's interesting over here is that the hourly RSI has now printed a bearish divergence right exactly at the overbought zone, at that rather extreme overbought zone in the last so this is the most extreme overbought level since February, right, almost a month now. So, and it's now has really exited from the overbought level after printing that bearish divergence, so indicating a bit of overstretch rally that was being seen yesterday. So this overstretch rally on the dollar yen, potentially there could be at least a minor dip for today on the intraday basis. So with that, we will flip to a intraday bearish bias on the dollar yen for today. 15130/80 will be my pivotal resistance level to watch. Two near-term resistance level, two near-term support level to watch out for. 150 figure /14955. Below it may expose 14890 next, which correspond to the 20-day moving average, acting as a similar support level, and as well as the minor ascending trend line that is still in place since the low of 11th of March. Only a push up and an hourly close above 15180 will invalidate today's intraday bearish bias to see a further squeeze up towards 14240 and even 15330 next. Right, so that's for the dollar yen. Flipping to a intraday bearish bias due to the weakness that is due to the bearish divergence or the bearish elements that's being depicted on the hourly RSI, indicating for a potential minor slide on the dollar yen with that extreme over stretch rally that was being seen yesterday. So using 15130/80 pivotal resistance zone, and we'll flip to a intraday bearish bias for today on the dollar yen. All right, so with that, let us now focus our attention to the major stock indices, starting with the Hong Kong 33, which is representing the Hang Seng Index. So Hang Seng Index yesterday we flipped to a bearish bias using 23,960 as my short-term pivotal resistance, where price action actually rallied, staged a bearish reaction of it, plummeted down, and reintegrate back below the 20-day moving average, acting as a first support level right now at 23,730, which is also today's Asia session high for the Hang Seng or for the Hong Kong 33. So still no change. I don't want to tie it so tight to 23,730. So still using 23,960 as my short-term pivotal resistance on the Hong Kong 33. Maintain that intraday bearish bias. Below 23,250 may expose 22,980 next. All right, only a breakdown below 22,980 may see a deeper slide for today, retesting 22,470, which is the minor swing low area of 20th of February and 4th of March, right? And also coming very close to the rising 50-day moving average as well. However, a sudden reversal and hourly close above 23,960 short-term pivotal resistance will invalidate today's intraday bearish bias on the Hong Kong 33 to see a squeeze up towards 24,000 24,180/350, a breakout above 24,350 may revisit 25,080 next. All right, let me put this in writing. Oops, 25,080. All right. So in a nutshell, first resistance level to watch will be the 20-day moving average that got rejected at the start of the opening of the Hong Kong stock market, where it shaped a bearish reaction, 23,730, because it happened to have an hourly close below 23,250. I don't want to tighten my short-term pivotal resistance to be at 23,730. All right, unless you have an hourly close below 23,250 in the afternoon session. So for now, we'll be still using 23,960 as my short-term pivotal resistance on the Hong Kong 33, representing the Hang Seng Index to maintain today's intraday bearish bias. Right. Up next will be the Japan 225 representing the Nikkei 225. So with that, yesterday we do have a neutrality stance over here. So right now what we see is that the price action of the Japan 225 managed to stage a squeeze up, but now come very close to a bunch of resistance zone that is confluencing graphically and mathematically as well, which is at 38,325/38,490 over here. Okay, the minor swing high area of 25th of February, 28th of February, confluencing with the downward sloping 200-day moving average and the 50-day moving average as well. And interestingly, the hourly RSI has broken down below a parallel ascending trendline support level. You can see over here, indicating momentum now has started to inch towards the bearish side of the story, and the RSI hasn't yet to hit the oversold region. So with that, we'll be using 38,325/490 short-term pivotal resistance on the Japan 225, flip to a intraday bearish bias for a downward drift. Near-term support level to watch on the intraday basis will be 37,595 followed by 37,380, which is the minor swing low of 21st of March and the minor swing low of 17th of March, confluencing with the 20-day moving average as well, very closely. All right. However, a push up with an hourly close above 38,490 short-term pivotal resistance zone upper limit will invalidate today's intraday bearish bias to see a squeeze up to revisit the next intermediate resistance zone of 38,760/38,880, which is also confluence with the descending trend line that I drew from the high of the medium-term descending trend line that I drew from the high of this 31st of January this year. So i.e. in a nutshell, using 38,325/38,490 short-term pivotal resistance zone on the Japan 225 representing the Nikkei 225, we will flip to a intraday bearish bias for a potential intraday downward drift towards 37,595, 37,380. That's for the intraday technical outlook on the Japan 225. Up next will be the European stock market represented by the German 30 or the German DAX. So the German 30 and German DAX yesterday, we do have a bullish bias. Price action almost hit our first resistance level at 23,180 before drifting downwards towards the end of the European session. And what you could see over here is that the hourly RSI is not that great as it's managed to break below a parallel ascending trend line support, indicating the lack of upside momentum or the revival of downside momentum coming into the Japan 225, coming into the German 30, pardon me, on the intraday basis. So with that, price action is still trying to hold above the 20-day moving average and still trading above our short-term pivotal support that we highlighted yesterday, which is 22,740, and also correspond to the medium-term ascending channel support that I drew from the low of 13th of January. So with that, rather lackluster observation or bearish observation on the hourly RSI, I'm not so confident to maintain a bullish bias for today on the German 30. So with that, we'll flip to a neutrality stance between 23,180 and 22,740 for today. Okay, so watch out for the 22,740. Hourly close below 22,740 may open up scope for a intraday bearish drop to expose the next near-term support level at 22,440 in the first step. and before that and below it may potentially see the next near-term support zone coming in at 22,240/120, which will correspond to the rising 50-day moving average. Right. So, i.e., in a nutshell, due to the bearish observation that's being depicted on the hourly RSI at this juncture, I'm not so confident to maintain the intraday bullish bias on the German 30. So with that, we'll flip to a neutrality stance for today for the German 30, representing the German DAX, neutral between 23,180, upper limit, lower limit 22,740 next. Right, so that's for the German 30. Onward next will be the major US stock indices. Let us start with the US Wall Street 30, representing the Dow Jones Industrial Average. So yesterday we maintained a neutrality stance. So the neutrality upper limit is being pierced up, and price action now is hovering at the upper boundary of this minor ascending channel that I drew from the low of 14th of March. Right, so this is the first resistance over here. Okay, so with that, the hourly RSI has now traced out a bearish divergence. All right, a bearish divergence, indicating the rather overstretched rally that's been seen in yesterday US session, and that it could be a risk of at least a minor slide taking shape to work out this extreme overstretched rally that's been seen in yesterday's US session. And the RSI also has started to exit from the overbought level after flashing that bearish divergence. So with that, we will flip to a intraday bearish stance on the US Wall Street 30 using a slightly a higher pivotal resistance zone at 42,980/43,120, which correspond to very clearly this minor swing high area of 5th of March and 6th of March that got rejected and kickstart this last leg of minor decline that we see so far, the recent last leg of minor decline. So with that, flip to a intraday bearish bias. Two near-term support level to watch will be yesterday's pierce up of that upper neutrality zone now turns into a pullback support level 42,250/42,055. The lower limit will be the gap up at the start of yesterday Asia session, and also correspond to the upper limit is correspond to the 200-day moving average as well. However, if you start to see a hourly close and a breakdown below 42,055, then this rally that we see so far will be increasing chance that is a counter trend dead cat bounce, or we call it a mean reversion rebound within its medium term downtrend that is still intact, exposing the next near term support level at 41,700 in first step slash 41,450, which will correspond to the minor ascending channel lower limit, the support, and the minor swing low of 21st of March and 18th of March. Only a squeeze up and an hourly close above 43,120 will see a much more pronounced recovery on the US Wall Street 30 for the next near-term resistance to come in at 43,460 in first step, which correspond to the 50-day moving average. Above it may see a further squeeze up towards 43,960, which is the minor swing high area of 3rd of March. All right, so i.e., due to the bearish observation that is being depicted on the hourly RSI, and the price action right now is actually hitting the upper limit of this minor ascending channel at 42,690. We will flip to an intraday bearish bias for a potential intraday slide in first step using 42,980/43,120 as my short-term pivotal resistance on the US Wall Street 30, representing the Dow Jones Industrial Average. Now, next up will be the Nasdaq 100. So the Nasdaq 100 yesterday, we do have a bullish bias. So price action hit the 20,150, 2,200, 20,150, 20,200 level. Also very, then you also now bank off the hit the upper limit of this minor ascending channel that I drew from the low of 14th of March over here. So what you could see over here, so there is also a bearish divergence that's being flashed out on the hourly RSI, and now the hourly RSI has started to exit down from the overbought level, indicating yesterday's push up is rather overstretched. Also, potentially there could be some sign of minor slide, at least in first step on the intraday basis. So using us, okay, so this the first resistance level will be this level here, the upper limit of that minor ascending channel, which is 20,190, but I'll use a slightly higher level at 20,340, which is the 200-day moving average, acting as a similar resistance level as well. So as long as 20,340 short-term pivotal resistance is not surpassed for today on the Nasdaq 100, we will flip to an intraday bearish bias. First support level to watch out will be 20,080. A breakdown below it increase the odds of this minor slide, at least in first step, to take shape towards 19,915/770, which is this breakout point of 18th of March and 20th of March, minor range support. Now that's the pullback resistance, and 19,770 was yesterday's Asia session gap up. All right, from here. So, however, if price action starts to reverse up and have an hourly close above 20,340, today's intraday bearish bias will be invalidated to see a further squeeze up to the next near-term resistance zone to come in at 20,700, 20,790, minor swing high area of 5th of March and 6th of March. Above it may see a further squeeze up towards 21,080, which will also correspond to the 50-day moving average, acting as a similar resistance level, as almost a similar resistance level as well. So, i.e., in a nutshell, due to the bearish observation that was being seen on the hourly RSI and price action hitting the upper limit of this minor ascending channel, we will flip to an intraday bearish bias on the Nasdaq 100 for today. 20,340 short-term pivotal resistance level, 20,340 short-term pivotal resistance level for a minor slide on the intraday basis, potentially in the first step. So that sum up the intraday technical outlook on the major stock indices. Let us now focus on the commodities asset class, starting with gold XAU/USD. So for gold XAU/USD, price action continues to be sluggish below the 3,038 short-term pivotal resistance that we highlighted yesterday. So still no change, still using the 3,038. So 3,038 short-term pivotal resistance on gold XAU/USD, still maintaining the intraday bearish bias. A breakdown below 3,000 may expose 2,978, and if 2,978 doesn't hold, it may expose further the near-term support level at 2,953, which will correspond to the minor ascending trend, minor ascending channel support level, which from the low of 28th of February, and also the rising 20-day moving average as well. However, a price action with a squeeze up and hourly close above 38 short-term pivotal resistance that will invalidate today's intraday bearish bias to see a recovery coming in for gold XAU/USD, retesting its current all-time high level at 3,058, then thereafter followed by 3,076, 3,090 next. So i.e., in a nutshell, still using 3,038 short-term pivotal resistance to maintain that short-term intraday bearish bias as it continues to work out its minor corrective decline sequence within its medium-term uptrend phase for gold XAU/USD. Okay, lastly will be West Texas crude oil. So West Texas crude oil yesterday rallied and hit our resistance level at 69.50 level due to that hawkish news coming out from Trump, stating that he will impose tariffs on whatever country that buys Venezuela oil and gas. So with that, the hourly RSI continues to remain bullish and it continues to trace out a series of higher low above the 50 level mark itself. All right, above the 50 level mark itself over here. So with that, we'll still maintain that intraday bullish bias for this continuation of this counter trend or corrective mean reversion rebound to take place within a rather choppy sideways range movement for West Texas oil. So this, you look at the daily chart of the West Texas oil, it continues to trade in this rather choppy range configuration, still inside this kind of a descending triangle range on a major time horizon since the low of March 2023. And now recently it just bounced off from the major range support of 65.40, and the daily RSI continues, the daily MACD continues to remain bullish as the MACD line, as the signal line continues to inch higher above the MACD line over here. So with that, this ongoing counter trend rebound phase within its major potential descending triangle range configuration could still have room to further play out. All right, so at least from a shorter term perspective, we will actually now have an adjusted short-term pivotal support level for today at 68 figure, which also correspond to the 20-day moving average. I think it's a similar support level as well. So as long as any minor pullback, first step will be at 68, 67. Second one will be 68, which is my short-term pivotal support level. So as long as the minor pullback didn't surpass below 68, adjusted short-term pivotal support for today. We will still maintain that intraday bullish bias for this potential multi-day corrective rebound sequence to play out. Above 69.50 may see the next resistance coming in at 70.80, which is the minor swing high of 28th of February and 3rd of March. Only a hourly close and a breakdown below 68 figure level short-term pivotal support for today will invalidate today's intraday bullish bias to see a choppy downward drift to expose the next near-term support level at 67.05/66.45 next. Right, that's for West Texas crude oil and also the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for and events to look out for today? So for today, during the European session at 5 p.m., we do have Germany business confidence data. They call it the Info Business Climate data for March out at 5 p.m. Singapore time. Market is expecting a slightly improvement from 85.2 in February to inch up higher to 86.8. So that could impact the euro dollar and the German 30 movement index. All right. And at 8:40 p.m. before the start of the US session today, Fed official will be speaking, a Fed cooler we were speaking. No tier 1 data for US. 9:05 p.m. Fed Williams will be speaking, and the next tier 1 data to come out will be at 10 p.m., which is the conference board consumer confidence. All right, so market participants will be looking at consumer confidence data from US. So we have the conference board one that is out at 10 p.m. Singapore time. Previously it was 98.3. Market is expecting a slight dip to 94 for the month of March. Then thereafter will be a rather quiet US session until we have early Singapore time tomorrow at 8:30 a.m. We have the Australia monthly CPI data for February. So this is on a monthly basis. Market is expecting a month-on-month at 2.5%, almost unchanged from the previous month of January, which is 2.5%. So that could potentially impact the movement of the Aussie dollar if it goes above expectation at around 2.7% or 2.8% for tomorrow monthly CPI data released for the month of February. So that is at 8:30 a.m. Singapore time. So with that, that sums up today's Daily Dose of Market Insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow.